Welcome to The Explainer. Today, we're diving deep into a really popular AI stock, BigBear.ai. Now, this company has an incredible story, a narrative that investors have absolutely fallen in love with. But the numbers, well, they might just be telling a totally different story. So let's get into it.
So, what's all the hype about? I mean, the story's just fantastic, right? You've got a company that's a pure play on AI, and it's smack in the middle of a massive boom in defense spending. On paper, it sounds like a slam dunk. But as the slide asks, what could possibly go wrong? Well, the equity research we're breaking down today suggests the answer is hiding in plain sight, right in the financial numbers.
All right, so first things first, why are so many investors so incredibly excited about this stock? To really get that, you have to understand the bull case. The report we're looking at lays out a few really key reasons why BigBear.ai looks so compelling, at least on the surface.
And here's that story in a nutshell. You have a company that is perfectly positioned in two of the hottest markets around, AI and defense. And look, they're not just talk. They've got real, high-profile contracts with the US Navy and even Nashville's airport. But the cherry on top? A super strong balance sheet, meaning they have a ton of cash to go after their big ambitions. I mean, if you're an investor looking for the next big thing in AI, this story, it is almost impossible to resist.
And this number right here, this is the crown jewel of that whole bull case. $391 million in cash. That is a massive safety net. It means that even at the rate they're currently spending money, what people call the burn rate, they've got over 3 years before they're in any real trouble. That is a lot of breathing room.
But, and this is a big but, here's where the story starts to show some cracks. The report's central argument is right here on the screen. The market is falling in love with the idea of BigBear.ai, not the actual reality of its business. The stock price, it argues, is being pumped up by speculation and hype, not solid financial results.
Okay, so let's do it. Let's pull back the curtain and really look at those numbers. Because this is where the simple, seductive story gets, well, a lot more complicated. The report points to 4 major red flags that seem to fly right in the face of that bullish narrative. Red flag number 1, and wow, is it a big one. While the entire AI industry is just exploding with growth, BigBear's revenue is actually going in the complete opposite direction. It's down 18%. Now, this isn't just a little blip. In a market this hot, for your sales to be shrinking, that suggests there's a serious problem somewhere inside the company itself. But wait a minute, you might be thinking, what about that massive $380 million contract backlog they're always talking about? Shouldn't that guarantee a ton of future revenue? Well, the report says, not so fast. In fact, the company actually blames its current revenue problems on disruptions within a key U.S. Army contract that is part of that backlog. It kind of makes you wonder how solid that big number really is. And that brings us to red flag number 2. And honestly, this one might be the most important. It's a fundamental problem with how BigBear.ai actually makes its money. See, investors think they're buying a sleek, high-tech, scalable software company. But the report argues that when you dig into the financials, it looks a whole lot more like a low-margin IT consulting firm. And this slide right here shows you exactly what that means. On the right, that's a typical software company. Look at those fat gross margins. We're talking 70, 80, even 90%. That's because they build the product once and then sell it over and over again. But on the left, you've got BigBear, with margins struggling around 25%. Why the huge difference? Because they're basically building custom solutions for every single client, and that takes a lot of expensive human labor. It is incredibly hard to scale up a business like that. Red flag number 3 is this really nasty cycle that the report calls the dilution treadmill. Let me walk you through it. Step 1, the company's operations burn through cash because they're not profitable. Step 2, to get more cash, they sell brand new shares of stock. Step 3, this keeps the lights on, sure, but it also waters down the ownership of everyone who already owns stock, making their slice of the pie smaller and smaller. And then you just repeat the whole thing to stay afloat.
And this takes us right back to that impressive $391 million cash pile we saw just a few minutes ago. Where did all that money come from? Well, it didn't come from profits. As you can see right here, the vast majority of it, $293 million, came from selling new stock. So the company's biggest financial strength is actually a direct result of that dilution treadmill we just talked about.
All right, red flag number 4. And this one might be the most telling of all because it's about following the money, specifically the money of the company's own top executives. Over the past year, insiders have picked up about 2.3 million shares, mostly as part of their pay packages. Okay, that sounds pretty normal, right?
But hold on. In that same period, those same insiders have sold almost 144 million shares. Let me repeat that, 144 million. That is not a typo. When the people who know the company inside and out are selling shares at a ratio of more than 60 to 1, well, that sends a pretty powerful signal about what they really think the company's stock is worth. So let's take a step back. You've got shrinking revenue, you've got low margins, you've got heavy insider selling. So how on earth is the stock price so high? This brings us to what might be the biggest disconnect of all, the company's valuation.
This table just lays out the problem perfectly. Take a look at that top row, the price-to-sales ratio. It's just a common way to measure how expensive a stock is. BigBear trades at 19.5 times its sales. That's more than 5 times its average competitor in the IT services sector. But now, just look down the column for BigBear. Unlike its peers, it has negative revenue growth and negative profits. It's getting this premium high-end price tag for a business that is, fundamentally, underperforming.
So, after laying out this amazing, seductive story and then walking through the brutal reality of the numbers, the report brings it all together with a final, very clear verdict.
And the verdict is bearish. Plain and simple. The report basically concludes that the cool story about AI and defense just can't make up for the serious risks of a broken business model and a valuation that is just dangerously high.
So let's just do a quick recap of the key arguments against the stock. You have a valuation that's totally disconnected from reality. You have a business model that looks more like a low-margin consulting firm than a high-tech software company. Revenue is shrinking in a market that's booming. That big cash balance is really just funded by watering down shareholder value. And finally, the insiders are selling like there's no tomorrow. It's a really tough combination to ignore.
So what's next? Well, the next major event to watch will be the company's third quarter earnings report coming up on November 10th. This is really where we'll see if the company can show any signs at all of turning these negative trends around.
And that brings us right back to where we started. It's the ultimate showdown. Will BigBear.ai find a way to rewrite its own story and finally get the numbers to back it up? Or, as this report strongly suggests, will the harsh reality of the numbers ultimately have the final say? For investors, that is the billion-dollar question.